All right, let's jump right into this explainer. Today, we're unpacking what is genuinely the ultimate liquidity trading strategy. But before we get into the mechanics of it all, we're going to start by confronting a deeply frustrating experience that, let's be honest, almost every single retail trader out there shares. If you've spent any time at all looking at charts, you know exactly what I'm talking about.
Seriously, has this ever happened to you? Have you ever watched your stop loss get triggered right before the market completely takes off in your favor? You find this seemingly perfect, textbook setup. You place your trade, and then you just watch in agony as the price drops, failing by mere inches. It tags your stop loss, takes you out of the trade, and then immediately reverses, going exactly where you predicted it would go in the first place. It is a completely agonizing feeling.
But here is the hard reality we have to face today. That is not bad luck. The market doesn't have it out for you personally. What that actually is a liquidity sweep. The sources we're unpacking today reveal that this scenario isn't some crazy coincidence. It's actually a highly calculated market mechanic engineered on purpose by large financial institutions. You aren't getting unlucky. Your positions are literally being systematically hunted.
Section 1. The Stop Loss Trap. How Retail Traders Become Target Practice.
To really understand how this trap works, we need to look at the massive contrast between a regular retail trader's limited view and an institution's overarching strategy. Picture this. You have breakout traders placing long orders, feeling confident with their stops resting safely right below a support line. At the exact same time, reversal traders are placing short orders, tucking their stops right above resistance. So what actually happens? The price intentionally breaks these levels just enough to trigger both sets of stop losses before completely reversing direction. Following standard support, resistance, and trendline rules perfectly sets a trap for both breakout and reversal traders at the exact same time. It's wild.
Section 2. Understanding Market Liquidity. Seeing the market like an institution. So, if we want to stop falling for this trap, we have to completely redefine what those standard chart patterns actually represent on an institutional level. Think of liquidity as a massive hidden pool of stop losses and pending orders. These pools are just resting there, accumulating around obvious swing highs, swing lows, trend lines, and basic support or resistance levels. We need to make it abundantly clear that these concentrated pools of retail orders are exactly what the smart money is actively hunting for.
And the underlying motive here is absolutely fascinating. Institutions intentionally target this resting liquidity, fill their own massive orders. See, large funds literally need your stop loss to execute their huge positions without causing major market slippage. When your long stop loss triggers, it essentially becomes a market sell order, which the institutions are more than happy to buy up to fuel their own massive long positions. They need you to sell so they can buy.
Section 3. 3 Crucial Trend Questions. The Ultimate Analytical Framework.
Now that we know exactly what the trap is, let's introduce the actionable solution. Our sources provide a very strict 3-question framework that you absolutely must apply before entering any trade. I highly recommend burning this rule of 3 into your brain. Question 1. What is the higher and medium time frame momentum? Question 2. Does the lower time frame price action actually align with that larger direction? And question 3. Is price currently trading at a premium, discount, or equilibrium level? Let's tackle that very first question about momentum. To figure that out, we have to look for a break of structure. Now, this is defined as a confirmed momentum shift that occurs only when a candle completely closes past the most recent high or low. The absolutely crucial point here is that to spot a true break of structure, we need a full, solid candle close. If the wick just pokes through a high or low and quickly pulls back, scratch that. That is a temporary liquidity sweep, not a confirmed momentum shift.
Section 4. Premium, discount, and equilibrium. Mapping the institutional price zones.
Moving on to that final question in our framework, we have to map out exactly where the price currently sits within a given range. Premium zones make up the upper half of the range. Naturally, they're considered expensive, meaning institutions are looking to sell up here. On the flip side, we have discount zones, which make up the lower half of the range. These are considered cheap, meaning institutions are looking to buy here. The takeaway is incredibly simple but powerful. If you want an institutional edge, you never ever want to buy in a premium zone, and you never want to sell in a discount zone.
And right smack in the middle is this magic number, 50%. This exact midpoint is known as equilibrium, and it represents absolute fair value between a swing high and a swing low. While price often reacts at this level, trading it comes with a very specific set of rules. Let's quickly break down how these Fibonacci-based levels dictate exactly where high-probability setups occur, In the premium zone, anything above 50%, you are only looking for selling opportunities. At equilibrium, exactly at that 50% mark, you shouldn't just blindly enter. You really have to sit on your hands and wait for strong momentum and clear order flow to show its hand. And down in the discount zone, below 50%, you are strictly looking for buying opportunities. This matrix is quite literally designed to keep you on the right side of the market, trading alongside the big players.
Section 5. Building an A-plus setup. Combining confluence for the perfect trade.
When we apply our framework to a practical bullish example, it reveals a really crucial distinction, even when you're safely looking to buy down in a discount zone. On one hand, an order flow zone features clear consolidation and heavily clustered orders. That right there is a high probability area. On the other hand, an isolated order block features very little volume and no real consolidation at all. Guys, that is a classic liquidity trap. Highlighting this is absolutely key. Even if you are in a discount zone, an isolated block is likely a trap. We need to see actual clustered order flow to validate our entry.
So let's recap how this entire framework comes together to build an undeniable setup. First, the higher timeframe momentum is strongly bullish. Check. Second, the lower timeframe trend line acts as an upside continuation, not a reversal, because it aligns perfectly with our larger bias. Check. Third, our validated order flow zone sits squarely in the discount level. Check. All three of our crucial framework questions perfectly align right here, giving us the ultimate green light to validate a massive long position. Once everything is aligned and screaming yes, here is the exact timeline of how you manage the trade execution. Minute 1, you place your limit order precisely at the order flow zone. Minute 2, you set your stop loss just a bit below the recent swing low. Hour 4, you zoom out and set your take profit target up at the 4-hour high. And day 1, you move your stop loss to break even the second that high is officially broken. This details the exact step-by-step life cycle of executing the trade. I really can't emphasize enough how important it is to protect your capital once the market structure breaks in your favor. Free trades are the best trades.
Section 6. Advanced Trade Execution, Precision Tools and Data.
Now, recognizing liquidity sweeps on a chart is really only half the battle. If you actually want to trade like an institution, you need the right data, 0.3 seconds. Our sources highlight platforms like Moomoo because they provide free US Level 2 data that refreshes at this blinding speed. When you're in the trenches trying to spot real order flow zones versus those isolated traps we talked about, having access to 60 levels of bid and ask quotes refreshing this fast gives you a massive, massive edge. You can see exactly where the true volume lies.
Executing this strategy consistently requires specific tools. With this setup, you're getting free Level 2 data via NASDAQ Total View. You also get 0 foreign exchange fees on US trades, which is huge because avoiding that typical 1.5% fee stops your profits from getting eaten alive. There's an 8.1% APY on idle cash for US users, and crucially, there are institutional trackers built right in to monitor exactly where the smart money is positioning itself. Utilizing tools like this directly supports our smart money strategy by heavily reducing friction and giving you way more visibility into the market's inner workings.
Let's test our 3 questions one more time, this time on an advanced bearish gold trade. First, we see strong engulfing bearish candles dictating our momentum. Second, a lower timeframe trend line is acting as a massive liquidity magnet for downside continuation. Third, the pullback perfectly reaches the equilibrium level order block, and when we zoom in, the 5-minute chart shows a beautifully clear change of character. By strictly breaking down those exact same 3 questions, they line perfectly once again to hand us another A-plus setup. It's like a giant puzzle coming together.
So, if there is one crucial point I want you to take away from this entire explainer, it's right here. Your goal as a trader is not to predict every single move. You aren't a fortune teller. Your goal is simply to understand where liquidity is collected. We aren't out here blindly guessing the future direction of a chart. We are systematically tracking the resting liquidity.
Which leaves us with this final, somewhat provocative question that I want you to ask yourself every single time you open up a chart. Are you trading alongside the institutions, or are you just providing the liquidity for their next big move? I challenge you to take this strict 3-question framework, apply to your own analysis, and stop donating your hard-earned capital to the market. Let the institutions hunt for stop losses somewhere else. Thanks so much for diving into this with me today, and I'll catch you on the next explainer.